Hello everyone and welcome to the time factor in trading. In other words, how to minimize your losing periods. Now let me tell you this, many people believe and think and they're setting their mind solely on making money, making profits when it comes to trading. But these people forget that in order to keep these profits and to actually make more profits and earn more money, you have to be able to control how much you're losing. Okay, what I mean by that, even before we start, let me try to illustrate the idea. If you're winning that much but then you're losing that much, you will not be making overall too much progress, right? You're not making that much progress. The idea is to win big but control the losses, so when the next wave of your winners come in play, you're actually making a lot more money here, right? So in the Traders Academy Club, we work with a lot of people all the time for years now, and all these issues are somehow popping up and you're able at some point to identify them. So I wanted to share my ideas here with you. And for those of you who don't know me, my name is Jordan Kuzmanov, guys. I'm the chief trader in the Traders Academy Club. I'm working side by side with Vlad. And I think what I have to show you today will totally change the way how you look at your performance curve, and it will not be just at the end of the day some line that goes up or down. It will be a line that can help you optimize your performance. So let's get into it. Everyone is using one strategy or a set of strategies. When you're trading, you have different strategies for the different stages of the market, let's say, or you're just based on one specific method of trading. It works for you, you stick to that. If it ain't broken, don't fix it, right? This kind of situation, and you go with it. Now, the market is constantly going to different shapes and cycles that are repeating themselves. Very important here. So usually what happens is you catch some winners, then the market behavior shifts. In other words, we call that waves, we call that cycles, we call that behavior. You can call it whatever you want. So let's say the market is trending, then the market is moving in a zigzag, then the market continues trading in one of the two directions, right? There are pretty much three states in which we can find the market: uptrending, downtrending, zigzagging, sideways move. Those are the three stages. All right. So usually when the behavior of the market changes, your strategy stops working, because let's be honest, there is no strategy in the world which is going to cover both market conditions, trending and zigzagging. Usually it's one or the other. So that being said, at that stage, which is totally unrelated to the subject we're talking about today, think about this. You will be better off if you have at least two strategies in your set of tools. One for trending conditions, one for ranging conditions. This is just a bonus tip for you. So once that happens, you start losing money, right? And what's the key here? The key is to be able to identify when your strategy is working and when a drawdown is coming in place. So if you have trending strategy which delivers money when the market is trending, you want to focus on big movers. Let's say this is the pound kiwi, the pound yen, the euro kiwi. All these pairs or commodities, gold, index, whatever it is, as long as it moves and it's trending, this asset is good for you. Most of the time you will be making money out of it, right? If your strategy is ranging one, you want to find assets that tend to zigzag, right? Range. So the hardest part usually for most people is you understand what your strategy does and what is its strongest suit, The hardest part is identifying whether the market is now ranging, consolidating before the next move, or it's simply zigzagging. This is the toughest part of all. Okay? And here we have the three things that we just discussed. You have a strategy. That strategy strictly depends on the market behavior or the market cycles, and then it's all about the timing, right? If you're using trend following strategy in a trending market, you will be making money. If not, you will be losing money. It is that simple. The problem is when it comes to the live chart and you look at it live, it's very hard to tell, right? And this is something I've noticed, and I see that as a problem for many, not even new traders. I'm seeing that in experienced traders as well. And no one is actually talking about these things, or at least not specifically detailed conversation on this subject. So let's talk about solutions. The first solution that comes to mind, of course, is you learn how to identify these market cycles or these market waves. If you understand how the market is waving and the structures of the market, then it's easy, because then you say, okay, this is where this uptrend finished. I'm expecting pullback. After this pullback from this zone, I'm expecting this to continue higher, right? Or this up move is finished, I'm expecting to see a range down. So then you immediately change your strategies from trending to zigzagging strategy, and you continue making money. Of course, it's not going to be 100%, but let's say if you make it 60-70% out of the times, you will be doing very good. Okay? So let's see what we have here so I don't miss anything. In this case, after you gain some experience, you could tell during what periods your strategies are making most money and when they are losing. This is exactly what we just talked about. This way of structures, the way the market creates these waves and these cycles, if you learn how to read them, then you can switch your strategy very quickly. Adapt, right? Constantly adapting. And this is the key. Most of the strategies work, okay, but under given conditions. Now let me give you an example. When the market switches from trending to ranging, right before the next market direction, one of the strategies that I'm using, which is trend following strategy, starts losing. So what do you do then? You try to adapt. Now, why does that happen? Because the strategy that I'm using for trending markets is having totally different characteristics from the strategy that I'm using when it comes to zigzagging conditions. In this case, I can use breakouts, for example, which I can trail and try to catch as many of this move has to provide. That's the first thing, right? Well, as it comes to ranges, I know my limitation. My target is limited to the box of the range, to this height here, right? So there you have it. So once I figured that out, I pay close attention to such situations. I also pay more attention to the reversal confirmation I'm going to be using. And again, all that right here is coming with knowledge and experience. And for most people, that could be taking months, years. For some, it never happens, unfortunately. It all depends on your personality. Different people, different preferences, different way of how you absorb the information that you're presented with. Okay, there is no unique pattern that works for all of us. Otherwise, we would all be selling and buying at the same time. Okay? Basically, the idea is to identify where the losses are occurring, the weak link, right? And fix it. Once you identify where the losses are occurring, this is already 50% of the problem solved. Now this is perfect and it works, and I do it on daily basis, all right, or weekly basis, depending on the time frames I'm trading. But it takes time, and I see people who are struggling with this thing, and they just at some point give up and they accept the drawdowns, and then they continue trading, all right. But what else can we do? We can use the time factor and the statistics, and this is my second solution for you guys. This is the core of this webinar. The second solution is based on analyzing your past performance and understanding the time factor. Now this idea came to me because we're doing algorithmic trading, robots and all this kind of stuff, right? So at some point we started playing with this idea, and then I figured out, why don't we use it when we manually trade, right? What's stopping us from applying this very same idea when we're manually trading? It's absolutely the same thing. So let me tell you what is it all about. So when you start looking at your performance, if you're consistent, of course, with what you're doing, you have to be doing the same thing. Or if you're using multiple strategies, you have to be analyzing just one given strategy. Otherwise, it will not work. Okay? If you're consistent with what you're doing, you will see repeatable patterns, just like you see repeatable patterns in the market. This way, you will see repeatable patterns on your performance curve. All right? You will also be able to calculate when the average drawdown is likely to happen. Remember that the drawdown is related to the market behavior. If the market is going into cycles and you're doing the same thing day after day after day, your performance will also be showing you these cycles. Okay, it should be copy paste. If the market is doing trend pullback, trend pullback, and you win here and you lose here, and then you win here and you lose here and you win here, that should be how your graphic looks like also. Okay, it should be following the same structure. So this is basically the first part of it. Now let's dive into it a bit deeper. How exactly does this thing work? Well, the very first step is to get the average drawdown for the period that you're going to be analyzing. In our case, I'm going to show you an example in a second. In our case, the average drawdown is around 200 bucks. You can also do percentages here. Okay, we're doing fixed amount of money. Then the second step, we're going to put in a table the time differences between each drawdown period that reached at least the averaged amount, right? And in a second you will see what I'm talking about. It's just that the image is too big and I wanted you to see it as a bigger image so you don't get confused. Now here is the key part, another key part. The more data you have, the more accurate and reliable your calculations become, all right? You can't expect to calculate 3 trades and then make a conclusion. The bigger the data sample, the more accurate the output is. Very simple. The second thing I wanted to mention here is that the math that I'm going to show you and the principles that I'm going to show in the next slide, they can be applied to any time frame. Let's say you're scalping the 1 minute chart and within 1 week you have 50 trades, for example. Then you can do the analysis for the period of 1 week because you have enough data samples. It's all about the amount of trades. It's not about time frames. If you have 300 trades in a day, you can be analyzing one simple day as well. 300 trades is more than enough. All right, I hope this point here is clear. Now, let's move on. So, this is the chart that I was referring to. At the bottom, let me just change the colors here so we see it better. At the bottom, we'll see the drawdown, and the drawdown in this case is represented in dollars, right? currency, not percentages. So what I did here is I took, this is the bottom and this is the maximum, slightly below minus 300, right? 320, 15, 20, I don't know. The middle part is around the 200 point, and that's why we have this line there. Okay, so it's very simple. Now this is approximately 15 years or so, 2000, when does it start? 2004 to 2017, many years. Okay, and the drawdown is not visible like this, but inside these tiny moves, when it comes to the doors, you can see that we had the drawdown, and this is what we're doing now. Pay attention, guys. We take every time the drawdown moved below the average point, and then it moved back up. So this is one, push up, we see the white space here, push down. And this is how we're going to take the data. You can do it manually, you can do it in Excel, you can automate it, I don't care. And every time you reach this zone, okay, you put it in a table. And once you do that, you can start seeing. So the very first one was, let's say, somewhere around January 2004. This is the first one, and then we start January 10, 2005, 1 year later. Then we have July, January, March, August, whatever the numbers are. We just take these periods here and we apply them to the table. And then we see between this one to this one, we have 12 months. From this one to this one, we have 6 months. And so on and so forth. Then what I'm doing is, how I'm calculating the average. Then I'm taking all these numbers right here, we add them together, and we divide them by the total numbers of inputs that you have. In our case, 1, 2, 3, 4, 5. So this plus this plus this plus this divided by 5 equals 7. So on average, we get 7 months, which means on average, using this given strategy or route or whatever it is, I'm going to see my average drawdown, which is $200 approximately, being reached. So what do we do in this case? I'm sure ideas are starting to pop up in your head already, right? I'll move on to the next slide. I was sure I'm going to forget it. That's why I put it here as a nota bene. We're looking at the balance drawdown here, not the equity. Okay, balance drawdown. This is important to be mentioned. Now, let's move on to the next one. Now, let's think about it, guys. It's very simple. If you're having, let's say, 2 great quarters, and think about the 7-month average. 7 months average, okay? And you have 2 great quarters, which means you're making money, making money, making money, making money. Usually it goes like that, but you get the point, right? The performance is mainly going up. And you're getting these minimal drawdowns. You know that statistically, a larger drawdown, excuse me, is coming. Now, I can do a few things knowing that statistically I expect the market to shift, because usually this is what's happening. If you're using the same strategy and you get these drawdowns, it means the market is not doing what we want. The way the strategy was built, now the market is in a different state, this strategy stops working. And once we figure out this part, we can start avoiding it. Not 100%, I'm not talking about that. No one is able to identify these periods like calling the absolute top or absolute bottom. Impossible. All right? You always give away a few pips from the top, a few pips from the bottom. It's very rarely when you're going to catch the absolute top, sell it, and then cash out at the absolute bottom. No. But just imagine that you're making money, and then this larger drawdown is supposed to come before it continues higher. What if you can avoid from this part to this part? Let's say anywhere from 50 to 70% of the drawdown period you can avoid. What about that? How would your performance look like then? So then, if we repeat the same and we take this part of the drawdown and we apply it here, and then we take this part of the drawdown and we apply it here, then we get that instead of this, right? And once you do that cycle and you go through that cycle 5 times or 7 times or 15 times or 20 times per year, per month, per week, things start to add up, okay? And it really starts to accumulate. And this is the key here. We limit the losses. We keep the same amount of profits, but we dramatically decrease the amount of drawdown, the amount of losses in our performance curve. Then you'll see after a few of these cycles what will happen to your performance. So what's the solution here now? Once we identify the average and once we know when we should be more careful with our trading, we start looking for solutions. One of the solutions is to stop trading completely, okay? The other solution is to lower the risk. If you're trading by default with 2% or 20 bucks per trade, okay, then you're going 5 bucks per trade or 10 bucks or 0.5% or 1%. You're decreasing the amount of money. So then even if you get this entire streak of losing signals, just because you minimized your risk, you will get the same output at the end. You will lose this much instead of that much. Same amount of trades, but you will be losing less. Okay? And a very important one here, this last final part. Duplicate your trading activity on another account, preferably a demo account. Or if you prefer to trade live under any circumstances, make it on a significantly smaller live account, guys. Then you continue following up your strategy, the signals that you're getting, and most importantly, the drawdown. So one of the best ways to do it is to have 2 accounts. One real account, one demo account. And once the moment for these drawdowns come, you stop trading the live account and you continue trading demo only. And then you can see this drawdown happening. I'm talking about if this is 10K account, this is 10K account. If this is 1 to 30 leverage, this is 1 to 30 leverage. Just duplicate it like they're twins. Do absolutely the same thing simultaneously on both accounts. And when the time for these drawdowns is set to appear, you cut this one and you continue trading this one only. Then you can follow up on the drawdown. Once the average drawdown, let's say your average drawdown is 200 like we had in the previous example, or it's 7% for example, once you reach that average, you start including the live account, the live account, and you start trading it again. Super simple concept. It doesn't require a lot of Excel, a lot of statistical knowledge. It's a very, very simple solution for a very huge problem with amazing potential to optimize your performance, guys. Okay, as we if I can use this metaphorical way to explain it, the risk reward ratio is fantastic here. Okay, and in reality, risk here is just some knowledge and time, right? You're not actually risking anything by applying this, but the potential reward that you get from this thing is amazing. And I promise you, apply this, all right, and just try to go through this thing for a few cycles. Something very important also, which is going to help you understand the way you're trading and your potential mistakes, is if your performance looks like this, okay, there is something wrong there. First of all, your strategy is probably not working, right? Second of all, sorry about the phone, guys. Second of all, if you see huge spikes and then this kind of moves, right, and then huge spike, that could mean you're not following the rules. It could mean you have a strategy which delivers huge risk reward ratio, and then you have many tiny losses, huge risk reward ratio, many tiny losses, and then again, but it would also mean that you're not following the rules, right? If this is a regular take profit and then you start getting this kind of stuff, like very tiny losses, which is good, but then very tiny profits, you're not doing something correct. So think about the way your performance looks compared to market behavior, compared to the strategy that you're using. Usually there should be correlation if you're following the rules, okay? And I've seen it time after time in my performance curves. If I'm following the rules, I see correlation, right? So this is another subject to think about, and hopefully it will make you a better trader. Now, I want to thank you for your time, guys. Of course, if you have any questions, leave us the comments below, and if anything needs to be answered, it will be answered by me or Vlad. Of course, don't forget to check out our Telegram group. It's absolutely free. You will get plenty of educational materials, plenty of trading setups, right? And it's all summarized in a fantastic channel, in a fantastic list. You can scroll back, you can find anything you want inside. You're never going to lose it, okay? So don't miss this opportunity. And of course, if you're not part of our trading family, check out the Traders Academy Club. You can find the link below. So that would be all, guys, for this session. Thank you for watching.